Thank you, Pat, and thank you, everyone. It's quite an honor to be here. As Pat mentioned, Keller Williams, this is our 32nd year in business. We started in Austin, Texas, and are now the largest in the U.S. Actually, largest in the world. We became largest in the U.S. last year. So here's what I'm going to do. I'm going to talk to you a little bit about digging a little deeper into the real estate market. We're going to look at some of the sales trends and prices. We're also going to look at a couple of the leading indicators that we have access to and that we have visibility in, and what they suggest for the market coming up. We're also going to talk about the real estate as an employment driver. We'll get to talk not just about the positive construction activity that we just heard about from Mark, but also about the real estate's role in the growing professional services sector. And then we're going to look at a couple of trends that we're paying close attention to: affordability and student loan debt. So, Pat mentioned earlier that that we are the largest, and we're actually at 127,000 agents as of the first of this month. We did, as I mentioned, we did start here in Austin, or down in Austin, Texas. I forgot I flew up here early today, so I'm in Dallas now. We have about 15,000 agents in Texas, and that includes about 4,000 in this area, in the greater Dallas area. Our model supports large offices, so when you think of a typical real estate office, it might be 20 or 30 agents. We have over 300 agents in our Frisco office, over 400 in our Plano office, over 500 in our Preston Road, and then more than 600 in Arlington. And then we have a large one in Fort Worth, and some of our people are here today, so thank you for being here. We have a pretty good pulse on the market because of having these boots on the ground and a lot of transactions that we have access to. So let's start looking at home sales. The green line is the national trend line, and the blue line is the Texas line. The main takeaway from this graph really is that the national real estate sales have not quite returned to the pre-recession levels. But you'll see Texas homes have recovered completely. We are back. In fact, we're now rising above where we were. Looking at the same data from a different angle, you can see that for the past 2 years, Texas has significantly outpaced the national market. Yet, because of tailwinds from the drop in oil prices that we heard about earlier, we expect growth next year to be closer to the national average. So we'll start to see that probably slow down. Let's take a look at the major markets in Texas: Austin, Dallas, and Houston. The big outlier here is Houston. Actually has negative growth year to date, and again, mostly in response to the drop in oil prices and the accompanying loss of high-paying energy jobs. It's worth emphasizing, though, that Houston is a very resilient market. The economy is diversified, much more so than I think people realize. And the softening oil demand has definitely taken some of the air out of that market, but we don't see anything dramatic happening. We've also, we'll touch on the quantity of homes that are selling. That's what the last graph was. This represents prices. Once again, the green line is the U.S. prices, and the blue is Texas. And that big sort of camel's hump there, that was the bubble, the housing bubble in 2008. Now note the corresponding lack of a bubble or hump in the Texas line. Now I'm from Southern California, and if California was on here, there would not be a blue line like that. We had a dramatic bubble that burst there. So while the national real estate economy has spent 4 years catching up to where it was, Texas has been going up and up. Median home prices. Here's what's happening with home prices in the major Texas markets. There's no surprise to no one in this room, I'm sure. Dallas prices are accelerating, which is good news for those that are selling properties, and maybe not so good news for someone who's purchasing a property. Why do prices go up? Which is funny for me to ask that question in a room full of economists and others. It's supply and demand, and right now we have tight inventory. There has been, with all the construction going on, all the cranes we see in all of our cities, there's still a shortage. In this area, it's partly due to the corporate relocations that were mentioned earlier, and the this area being such an attractive area for job seekers. So the challenge in all of this growth is affordability. And Dallas has been getting less and less affordable the past few years. And that has implications for the area's ability to continue to attract the young and creative workers who will fuel the region's long-term growth. Quickly, let's touch on the inventory and housing starts. Inventory is simply a measure of the time it takes for a property to sell. Economists generally consider it to be a balanced market when there's between 4 and 6 months worth of inventory. As you can see, Dallas in orange is veering towards 2 months of inventory, so it's definitely a hot market, what we would call a strong seller's market. Houston, for the reasons we covered, is moving in the opposite direction, and that will still be, although it's moving in the opposite direction, it's still a relatively strong market. Now, here's what housing starts are in Texas. And as you can see, there's more single-family homes being built than multifamily homes, which I know for me in Austin is a little surprising, because when I see the cranes and the high-rises going up, it looks like there's just an incredible amount of multifamily construction going on, and I'm sure the same here in Dallas. But because of the availability of land, our communities are getting wider and broader. Housing starts in Texas, as I said, are right now being outpaced by single-family home, and there's probably not enough of either. We're still the market's still able to absorb a lot more than we have going on, and that's evidenced by how we see prices reacting. Now, mortgage rates. All of this gets affected by mortgage rates. And I'm not going to say a lot about this because, quite frankly, there's a lot more people in this building that are more knowledgeable than I am about it. But I do want to point out that if and when the Fed raises rates, there will still be things will be very affordable by historical rates. When Gary Keller started in real estate in the early 1980s, interest rates were in the 17% range. When I started in the late 80s, they were still way up into the double digits. The blue bar represents the historical average from 1990 to 2007. And the orange bar represents the rates that we've been experiencing in the past few years. So even if rates go up 0.25%, 0.5%, or even a full percent, it's still cheap money from a historical standpoint, and still makes it a good time for people to be able to invest in real estate. And if there happens to be anyone in this room that's interested in that, I know a few people that can help you. So the last data-intensive slide that we'll look at is student loan debt. Now, you may not immediately think of how this relates to real estate, but we do look at it, and it does have an impact. And basically, the debt load that students are graduating with affects the kind of homes they buy and can qualify for, and it certainly delays when they do get into the housing market. And that has an impact or a ripple effect on the real estate market. So looking into the future, we don't talk about this a lot, but as a company that handles more than 10% of the real estate transactions in the U.S., we have visibility into a couple of pretty strong indicators, and this seems to be like a good audience to share some of those insights with. We have a unique operating system where on a single day of the month, every month, we get transmitted to us all of the data from all of our offices around the world and all of our agents in those offices. So we get a tremendous amount of information. Two things that we look at that are leading indicators for us are, one is our listings taken. Now, those are properties that an agent has signed an agreement on that will be going on the market in the next 30 or 60 days. Basically, the seller has chosen a Keller Williams agent, and they want to get their home sold. If it happens to be in Dallas, it goes on the market, and that's sold pretty quickly. In North Texas, listings taken for August was up 24% over this time last year. So for comparison, listings taken in all of the U.S. and Canada is up about 15%. That means there's a lot more homes coming on the market in Dallas than there were last year. Now, I mentioned earlier that there still seems to be a shortage, or there still is a shortage, which is driving prices up and affordability down. That means things are just selling faster, or as fast as they're coming on. The second leading indicator we look at is what we call contracts written. And these are contracts that someone has written to purchase a property, and these properties will close in the next 30 or 60 or 90 days. And this is a really strong indicator of how much money, well, number one, how much money real estate agents are going to make, but also how much home sellers, home inspectors, title companies, mortgage lenders, and all the people involved with the transaction are going to be impacted by. In North Texas, our contracts written for August it was up 23% over last August, which again is a very strong growth number. And these transactions represent, at minimum, like I said, 2 to 3 more months of very, very predictable numbers, but probably another 2 or 3 or 4 months beyond that of activity, because when properties sell, it creates move up and move down buyers, and the dominoes continue to fall. Now, all these sales are good news for agents and franchise owners. Our commissions are up about 20% year over year. Our owner profit for our franchise owners is also up about 20%. So from our perspective, real estate's looking good in Texas and throughout the U.S. Now, in recent months, as a company, we have hit all-time records in almost every major category that we track, and we're cautiously optimistic about next year. Now, that being said, every day that you're in a good market also means you're one day closer to the next adjustment, and we think we are probably closer to the next shift than we were coming out of the last one. Now, what does that mean in terms of time frame? I don't have a crystal ball any more than anyone else, but we do believe in the next 12 to 24 months, many parts of the country will start to feel a change and a shift in the market. In the past 12 months, KW agents, and remember, we're basically about 10% of the industry. Our agents have handled over 800,000 transactions on either the buy side or the sell side for homeowners and home buyers, totaling almost $200 billion and about $6 billion in commissions. So we've seen a lot of growth in the numbers of agents. Those agents are building bigger and bigger businesses. Our offices are continuing to grow, which is all reflective of the strength of the real estate market. Our agents are forming teams. They're creating businesses that expand into additional markets, which is a relatively new trend in our industry. And the best of those agents are using technology. As Mark said, in the construction industry, same in our industry, a tremendous amount of innovation going on that is absolutely having a positive impact on the customer experience and in the home buying and home selling process. So it's an exciting time for us to be in real estate. We are extremely excited to have a big percentage of our business in the state of Texas because it's such a strong market. I am honored again to get to be here and speak with you, and thank you very much.